Welcome to the Dakota Research Podcast. This podcast is for informational purposes only and should not be considered investment, legal, or financial advice. The views expressed are those of the speakers and do not necessarily reflect the opinions of Dakota or its affiliates. We do not provide investment recommendations or solicit investments in any securities or funds. Listeners should conduct their own research before making any investment decisions.
Welcome to the Dakota Research Podcast. As always, you have myself, Chris Leroy, and Alex DeMarco here from the desk. Today, we're going to be bringing you a deep dive segment on asset-based finance and asset-based lending, two fast-growing segments within the private credit landscape. We're going to be talking about why private equity and private credit firms are taking over the space, the market trends, mega deals driving growth, and the key takeaways for investors to pay attention to. We're going to be just defining asset-based finance and asset-based lending. But before we get into all the market trends, let's just get something clear between asset-based finance and asset-based lending. Often these get used interchangeably, but they're not the same thing, right?
Yeah, definitely. So asset-based finance, ABF, as we'll use to reference that, is the big umbrella. So think any financing arrangement secured by an asset. So that could be a loan, a securitization, factoring, structured credit, things like that. So the financing might be for an entire business. It could be for a specific asset within that business, with that asset serving as the collateral, essentially. So real estate finance, for example, would fall under that ABF umbrella, the property itself being the collateral.
Yeah, and then you have asset-based lending, or ABL, which is a narrow slice within ABF. It usually refers to loans made to businesses secured by tangible or financial assets, often where new money is lent. That's closer to direct lending. But instead of being backed by corporate cash flows, it's backed by specific assets.
Yeah, and a good example there would be maybe a manufacturer taking out a working capital loan and pledging its accounts receivable as collateral. So that would be like pure ABL right there.
So all ABL is ABF, but not all ABF is ABL. That's worth keeping in mind when we go through the big market developments and deals later. Now that we've defined the difference between the two segments, let's look at how they actually work in the real world.
Yeah, sure. So at its core, ABF involves advancing funds against an asset or a pool of assets with those assets serving as collateral. So that can take a couple forms. One is a working capital lending, so ABL. Those are credit facilities that are secured by receivables, inventory, other sort of shorter term assets, if you will. Securitizations is another one. That's packaging consumer loans, leases, or receivables into a tradable security or securities. Leasing finance. This would be providing capital for assets like aircrafts, equipment, or vehicles where lease payments would be servicing the debt. And then project or infrastructure finance, longer term loans here secured by the cash flows from a specific project. So maybe a wind farm, a data center, toll road, things like that.
And we'll talk a little bit about some of the recent data center transactions that we've seen. But the big unifier is that repayment comes from the cash flows or liquidation value of the asset, not purely from corporate cash flows as in direct lending.
100%. And within that, ABL is the most widely recognized form in day-to-day commercial finance. So in a typical ABL deal, the lender will calculate a borrowing base based on the value of the eligible receivables or inventory. The advance rates, they'll set those. It might be 80 to 90% of receivables, and then maybe 20 to 40% for inventory or equipment. And this borrowing base, they recalculate it pretty regularly. It could be weekly, it could be monthly. So that credit availability can move in step with the level of assets available. The lenders, they really often require cash control mechanisms like lock boxes where payments from the customers go directly to pay down the loan. And the facility is self-liquidating. So as these receivables are collected or inventory is sold, that loan balance will reduce and the funds can be redrawn as needed.
So ABF is the umbrella that covers everything from financing consumer loan portfolios to building billion-dollar infrastructure projects. And ABL is one very active slice of that pie.
Exactly.
So why is the market shifting from banks to private credit?
Yeah, a lot of stuff happened not only in asset-based finance, but in other areas as well. Post GFC in 2008, I think the Dodd-Frank in the US, Basel III and IV in Europe, these higher capital requirements are making some type of lending kind of unattractive for banks.
And banks have also pivoted towards fee-based capital-light activities like wealth management.
Yeah, and if you add in the 2023 US banking turmoil, higher deposit costs, general pullback from the non-core lending, and the space was really wide open for these private credit and private pools of capital step in.
So there's been a lot of sort of structural drivers behind this trend, but there's also a number of sort of macro-oriented things. So the timing couldn't be more interesting on that front.
Yeah, 100%. The macro backdrop is really shaping the demand here in several ways. So if you think about the interest rate environment we're in right now, we have higher interest rates. So these floating rate ABF facilities are delivering stronger income for lenders than in maybe the low rate years of 2020 and 2021. These credit spreads in ABF have held up even as some corporate direct lending spreads have compressed, making ABF pretty attractive. Sector-specific demand is surging as well. So aviation finance recovery, the explosion of data centers and AI infrastructure as well as the growing consumer credit securitization volumes as well. And then if you look at bank approval rates as well for small and mid-sized business loans, that's fallen to multi-year lows. So that is really widening the gap that private credit is filling there.
And that's why we're seeing both traditional players and new entrants rushing into the space.
100%.
So these private equity and private credit players have definitely stepped in, with enthusiasm.
Yeah, and I'll put some numbers around sort of the growth here in the market. So the private ABF market is estimated to be at over $6 trillion today, and that is anticipated to hit 9.2 by 2029. Private markets have only about 4% penetration, so the runway is pretty big.
It offers attractive risk-adjusted returns, diversification benefits, and also strong downside protection.
Yeah, and because ABF, ABL requires specialized underwriting, asset valuation, and monitoring, it's not really easy to replicate. So that's kind of creating barriers to entry and protects returns for the managers that have the experience and the skill to return.
And let's put some context around this too, because I think that's very helpful to see some of the big moving blocks that are happening within the industry too. So to make this real with some of the big recent deals, and this time we'll call out whether they're both ABF or ABL.
Yeah, I think just a couple weeks ago, KKR, they raised $6.5 billion for their second vintage of their asset-based finance partners fund, and some related accounts make up that 6.5, but that's targeting consumer loan portfolios and infrastructure assets. Another deal from KKR, they acquired a large consumer loan portfolio from Harley-Davidson.
This was a recent transaction.
Yep. So that's part of a strategy that now represents roughly $75 billion of KKR's AUM. So becoming a much more significant portion of their strategy in terms of AUM. If you look to Carlyle, another big player in the private market space, they closed a $2 billion asset-backed financing with Diversified Energy Co., securitizing cash flows from mature U.S. oil and gas fields. Speaking of Carlyle, that firm and Citi, they partnered to provide asset-backed financing for fintech lenders. So seeing some banks as well as some private credit lenders coming together and providing solutions, which is interesting. A couple more examples here. Sixth Street and Firm, they came with a multi-year agreement to purchase up to $4 billion in consumer installment loans from Affirm Holdings. PGIM Fixed Income and Affirm, they completed a $500 million purchase of Affirm's asset-backed loans. If you look at Meta, this is another new one. They secured a $29 billion package for data center expansion. PIMCO is providing $26 billion of debt. Blue Owl is providing $3 billion of equity. This is all backed by the digital infrastructure assets and cash flows. XAI, Elon Musk's venture, they raised $5 billion in asset-backed loans as part of a $12 billion debt equity raise for its Colossus 2 supercomputing data center. This is collateralized by up to 1 million NVIDIA GPUs, hardware, and AI IP. A couple more here. Blackstone and Santander acquired $1 billion portfolio of infrastructure loans from Santander, and then Apollo and BNP, the Atlas SP platform, secured a $5 billion initial commitment to support investment-grade asset-backed credit, including large-scale infrastructure projects.
Yeah, and if you look at those deals, they just show how diverse ABF and ABL can be, from consumer loans and oil field projects to fintech portfolios, hyperscale data centers, other infrastructure projects that we mentioned, XAI,
Yep.
Very unique financing arrangement too. But then as you listed them out too, you saw some notable flagship funds being raised, $6.5 billion recently by KKR, as well as some partnerships between sort of traditional Main Street lenders alongside private equity platforms as well. Let's look at a couple of case studies. We talked about ABF as the big umbrella and ABL as one of its most common forms. Let's make it real with two examples, one classic ABL facility and one large-scale ABF transaction, so you can hear how they differ in practice.
We'll turn to ABL first and give a working capital facility example. So if you imagine a mid-sized U.S. manufacturing company, they need $50 million in working capital to ramp up production for maybe a big seasonal order, let's say. Instead of an unsecured term loan, the lender offers a revolving ABL facility secured by accounts receivable and inventory. So in terms of advance rates, let's say 85% on eligible receivables, 40% on inventory. The borrowing base, as we mentioned earlier, recalculated weekly as invoices are issued or inventory changes. In terms of monitoring, monthly field exams and quarterly inventory appraisals occur. And then from a cash control perspective, customer payments go into a lockbox, which are going to be paying down that loan before new draws are made. If receivables age out or inventory becomes obsolete, the borrowing base will shrink, which will protect the lender while keeping the company funded for operations.
And that's the self-funding or self-liquidating rhythm ABL is known for, constantly adjusting in step with the short-term assets themselves.
Yeah.
Now let's contrast that with one different ABF deal, one in the consumer credit space.
Yeah. So I mentioned earlier the 6th Street and Affirm deal. That was a multi-year agreement, $4 billion in consumer installment loans originated by Affirm.
This is the buy now, pay later.
Yes.
Group.
Yep. So the collateral is the loan receivables from their buy now, pay later portfolio. The cash flow source is the borrower's repayment streams on those loans. And the risk control here is pool performance monitored continuously, and the receivables are structured in a bankruptcy remote SPV, which will protect investors.
So while both are asset-backed, the timeliness, collateral types, and repayment mechanics are different from year-long infrastructure build-outs to rolling pools of consumer loans in these cases.
Yeah, and that's sort of the beauty of ABF, right? Like it's a toolkit that can be adapted to almost any asset type or industry.
We talked a little bit about transactions. We've seen some major strategic moves that are reshaping the ABF and ABL landscape.
Yeah, I mean, one to think of immediately is BlackRock, their $12 billion acquisition of HPS Investment Partners, which was completed very recently, actually. So this is a massive push by BlackRock into sort of private financing solutions, really building their public fixed income franchise and sort of taking that, combining it with HPS's private credit and CLO expertise. That new platform together manages over $190 billion in assets, positioning BlackRock to originate, structure, and distribute ABF and ABL deals at a pretty crazy scale.
That's a platform level enabler.
It's part of a broader wave of expansion too. Like we're seeing this other places. So Blue Owl acquiring Italia Capital Management, TPG acquiring Angelo Gordon for their structured credit products, KKR taking full ownership of Global Atlantic for their permanent insurance capital, Apollo and Athene emerging, Athene bringing that ABF funding expertise, and then Brookfield investing in Castle Lake to expand their aviation, real estate, and consumer finance ABF.
So the large firms have been very active to acquire capabilities in these areas. Mm-hmm. So technology is playing a big role in it too. So one thing that's changing fast is the technology behind ABF.
Yeah, 100%. So managers are using real-time data feeds from borrowers to monitor collateral daily, not monthly. And, AI, everyone's using AI for different things. Here specifically, it's flagging anomalies in receivable patterns. Blockchain-based registries are emerging for tracking certain asset classes like equipment or receivables, and that's really going to reduce fraud risk. This technology is making ABL and ABF a lot more precise, as well as being a lot more transparent and really lowering the risk of any surprises that might occur along the way.
Yeah, because as you were explaining it earlier too, just the mechanisms for how these loans are monitored or priced, you need to have this technology stack built in or to be acquired from another platform in order to do it too, because the banks have developed these internally over the years. But now the private equity firms, private credit firms have to have that same technology embedded within their platforms to make the origination and monitoring capabilities really work together. So for investors, where does ABF fit in the portfolio?
Yeah, so again, it fits in the broader private credit portfolio, but it's a little different. It's a bit of a diversifier from your traditional direct lending. It's a little bit less correlation to public markets, and it can really deliver some strong income with some downside protection as well.
And we've seen a number of different access points or options via products that have included interval funds, think quarterly liquidity, 1940 Act, reporting, also evergreens and BDCs, which are continuously capital raising vehicles that have been really targeted at the private wealth channels, where we've seen focus there, as well as institutional drawdown funds, sort of the traditional format of private capital commitments that are sort of deployed over time. So we've seen these in the three different channels, but new vehicles are being launched every day, particularly within interval funds and evergreen funds as well.
Yeah, and it's really attractive to a ton of different LP bases. But if you think about insurers, they like ABF for that potential capital efficiency under regimes like Solvency II. Pension funds love it because you get that stable yield and low historical loss rates. So beneficial from that perspective. And the private wealth market is becoming more attractive to the space as well, and really seeing ABF as a fixed income alternative, but better protection.
And it makes sense too, because a lot of folks are looking for these more liquid vehicles, but also where the returns are coming from a disproportionate amount of the income profile of the underlying assets themselves. So it kind of feeds on itself nicely.
Yeah.
So in short, asset-based finance and lending are becoming core pillars of the private credit universe then.
Yeah, and then you have these deals like the KKR Harley Davidson portfolio. We talked about Sixth Street and Affirm, XAI, their GPU-backed debt raise, BlackRock buying HPS, like all these things, like the scale and diversity of asset-based finance and lending is pretty real.
So the next time you go out to buy your Harley Davidson, your loan could ultimately be owned by private equity.
Yeah, probably.
Well, I think that's been a great summary, great time, just going deeper into a very topical point on asset-based finance, asset-based lending that are becoming big pieces of the private equity picture. So thanks for walking us through it today.
Yeah, of course. Thanks to everyone for listening.
Take care.
Hello, everyone. Just wanted to say thanks for watching. Hope you enjoyed the show. One thing that I think you do know is all of this information that we covered exists in Dakota Marketplace, our institutional investor database. Even this show that we just cut will end up in Dakota Marketplace so you can view it. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.